Okay, testing, testing. 1, 2, 3, testing, 1, 2, 3. The rain in Spain falls mainly on the plains, the ants in France. Stay mainly in your pants. Hey, 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 hey da boo boo, how are you doing? Welcome to the Harvard Club of New York, in the room dedicated to the class of 1936. Go 3-6. Let me remind you that trading is risky, not appropriate for everyone. Past performance, good or bad, not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. All right, so how you doing? How you feel? How you look? I'm looking and feeling great. How about yourself? So we have some inflation in the United States of America. We knew that. The interest rates are going to go up in the United States. We knew that. So we're jostling for position. The types of inflation that we have, if you look at the subcomponents of the CPI that came out, looks like the inflation wouldn't be sort of transitory. Even if some of it's transitory, some of it is likely to be what economists call sticky. And all this needs to be priced in. And right now, there's about a 50-50 chance of interest rates going up either 25 basis points or 50. Now, this is pretty amazing because 4 months ago, we thought there was going to be a 50% chance of no rate hike and a 50% chance of 25 basis points. So essentially, the expectations now is the Fed doubling what we thought just 4 months ago. So we look at the charts, and the charts tell us what people are pricing in and how they're positioning themselves. By the way, how is the sound? Sound and charts okay? Yeah, cool, great. You want some coffee? Yeah, baby. Now, one of the things that we could do is we could analyze this euro dollar. It's 40% of the entire market, so obviously it's going to tell us a lot. It has made a slight lower low. And there might be an opportunity to sell a new lower high. This Bollinger Band was from the swing trading group last night. I don't think we need it here. It was part of a conversation about tunneling. Trying to get rid of it. There we go. Cool. Let me get my EpiPen. Michael's very understandable. Well, that's good. Hey, Michael. All right. So since the market is 50-50, I need you to choose what team you're on. Okay? If the Fed is raising interest rates very quickly, and let's say to some point a terminal rate being high, then that will slow the economy down in multiple ways. I've shown you many times over the last recent weeks why the stock market came down. Had to do with math. So we did the maths. If you remember, I showed you two models, the capital asset pricing model and the discounted cash flow model on how to price a stock. Cool. So the issue is if the Fed is raising more quickly, so 50 basis points in March, and then again in the June meeting, that means they are slowing the economy down quickly, and you might be in the camp where like that's too quickly. Essentially, the risk here is that not only do they kill inflation, but they kill the economy. It causes a recession. So if you're in that camp, that we're facing a recession, you're probably a dollar bull. Not just for the next 5 weeks, but certainly the next 5 months. Okay? Now, I'm in the other camp where I don't really describe what we're going through or about to go through as raising interest rates, but returning interest rates back to at least a neutral price. So, for example, let's say inflation was 2%, interest rates could be 3%, and yet right now interest rates are zero, essentially, right? So we have to normalize them. Interest rates should go back towards 2. And so if we raise interest rates from 0 all the way up to 2, that should not cause a recession. Meanwhile, over that period of time, that inflation should come down a little bit. And so interest rates going up, inflation coming down, and maybe in 18 months, maybe in 2 years, we're back to sort of a normal rate, a balanced rate, where growth and inflation and interest rates are all moderate. Okay? So in that case, I think this could go up, not necessarily this month. That's the issue that I'm facing, where, well, you can see what's drawn on the chart. I think there's a lot of down. Now, I can see, I think, I've forgotten, the streaming software for me to stream to YouTube freezes up the machine for some reason. CPU at 12%, so that's not a big deal. There seems to be the platform or something lags and stalls. I can't believe that. So it looks like I can't control my chart. My chart's dead. It says CPU at 12. That shouldn't be a problem. That's really too bad. I'll have to, once again, maybe update my OBS. So Roger, I might have to stay on this chart. I might have to stay on this chart. I'm going to switch this over to Aussie dollar in hopes that it might actually change. So anyways, so you got to pick a team is what I'm trying to say. Now Roger says, hey Wayne, could that be beneficial in the long run? Can you describe what you mean by that? I'm not sure if you mean having interest rates higher, or I don't know if you mean a recession. Okay. Oh, well, it's not an issue of too soon. We have 0 interest rates and 7% inflation. Yeah. So the next one would be the causing the recession. That would not be an issue of soonness, because many people would say we're already late, so there is no too soon. So then the next issue is too much or too fast. And, oh look, this is finally changing. So I don't know. I don't think it's a real risk. Again, because we have growth, we have jobs, wages are fine, and raising interest rates all the way to 2%, all the way to 2%, should not be a problem at all. So really, if the Fed raised interest rates to 7%, that could be it, right? But look, typically when we're in a situation like we are now, wrapping up quantitative easing and raising interest rates, usually the market is still a little bit timid. We've just come out of recession. We're just hiring people back. We're just getting companies profitable again. with decent outlooks, for the near future, and so on and so forth. But we're way beyond that. Top of the morning to you, Maddie. Okay, so we're beyond that. So again, I look at that we're only going to neutrality. The risk, again, would be the Fed looks at 7% in inflation and jacks up interest rates to 7%. Yeah, I don't think that's happening either. Okay? Oh, good, look at that. The chart's changed. But will it open the Aussie? Maybe I'll leave it here for a second. Okay, sorry about this, guys. Okay. Yeah, so I don't think there's a lot of risk for me to worry about. Like, I'm not worrying about it like some market participants do, but you have to realize some market participants are invested in let's say a bond portfolio or a stock portfolio that have a high beta towards inflation and interest rates. And that what a high beta means is they're highly sensitive to the change. But what we do, we're not that highly sensitive, not like a certain bond portfolio or a certain stock portfolio. And so they're very, very worried because if you raise interest rates 1%, the value of the stock might drop $1 billion. Oh yeah, first time in a different room. Yeah, this is the Harvard Club of New York. Nothing fancy. I usually don't like beds in the background and stuff like that, but it's just a really, really, really old building, and it's truly like spending the night in a museum. Like, no joke, this place is wild. Definitely. From an era long gone. Okay. All right, we have a question here, and I'm not going to address it fully because it's too long of a conversation. Okay, but if price increases 10% and income increases 10%, has anything actually changed? Do you consider that inflation? Well, so we don't have a huge, long, economic lecture, let me break it down into smaller pieces and just have a smaller answer. Okay? Typically, price is related to demand, and demand is related to income, and you're asking about income and price, but where does income come from? Income comes from an exchange of productivity for resources like money. So you go to a job and work, make money for the company, and they pay you a wage. So if there's lots of productivity in the company, and every company in a country, the entire country has a lot of production, produces a lot of stuff, and therefore that stuff creates income. And then if everyone has income, then prices go up, and then it kind of moderates. So the saying of the rich get rich and the poor stay poor, that there's that's partially to explain that, because rich people don't earn wages. They own the factory. They're not a factory worker. So the factory worker, no matter how much money they get in their hands, will never have quite enough, because then the prices go up if all the workers have jobs and money, right? So you're saying if there's a 10% increase in price but 10% increase in wages, then nothing actually happened. Sort of. That would normally be true. But in our case, let's talk about that, because I think that's what you're asking too. In our case, some of, if not most of the inflation that we have, which is the increase of price, isn't from the increase in wages. So we have 7% employment, but wages have gone up a lot less than 7%, okay, in real terms and all these things. So what explains it? Well, in this case, we have 10% income increase in price, but not a 10% income, not a 10% increase in income, but it was non-productive money supply. It's sort of like somebody that has a low-paying job, but they drive a BMW because they can lease it. You're like, you can't afford this BMW. And they're like, well, I can afford the monthly payments. And you're like, well, the monthly payments are like 10% of your monthly income. Yeah, well, I've always wanted to drive a BMW. All right, you can't afford it, but you have it. So now some of the wages, which is the income increase, didn't come from productivity, but came from debt. And that's what the problem is. Okay? Okay? Great. So that's the short answer. So is a 2% increase a risk for a high beta portfolio? Look, if someone, just think of it as leverage. If somebody leveraged up on a dangerous bet, a small change will have a big, profound impact. Okay? So it's in that case, it may not necessarily be leverage, but they bought assets that were highly sensitive. So part of their bet was inflation was going to be near zero and interest rates were going to be low for longer. And they thought because of this, these highly sensitive stocks will outperform a balanced portfolio. Well, now they're getting crushed because it's not a balanced portfolio and they're just sitting on high risk because the highly sensitive beta now is working against them. You understand? So it's just they've made maybe some poor bets, like the ARK fund, for example. All growth. Okay? All growth. All right? Well, that works when growth is going up, but then when growth is coming down, okay? So anyways, so I don't think we're as sensitive to that. As currency traders, we're interested in the health of each individual economy and their ability or willingness to trade with each other. Now, we might have a country that wants to trade with us, but they ain't got no money, or they haven't made any stuff. Well, then there's nothing to trade. They want to trade, but they can't trade, okay? Or the other way around, they have a lot of stuff, they have a lot of money, but they don't want to trade with us, so money won't exchange hands. No business deals are going to get done, no money is going to cross borders, no change in valuation. So we need to look at first, how is the Australian economy? How are they doing? And then the second question is, how are their relationships with their trading partners? So if China now is in recovery mode for going through a bad period, well, let's start with the bad period. The Chinese economy slows down and they're having a bad period. Okay? Their productivity falls, they have less money, let's say, and less need for stuff from Australia. There's less demand for iron ore, less demand for coal, less demand for gold, less demand for diamonds, less demand for Shiraz, less demand for everything. And right? Not just for Australia, but for everything. There'll just be less demand for absolutely everything. That's called aggregate demand, or AG or AD. So part of that aggregate demand, because it's an open economy, is going to be this trade component. Okay? So now the trade component is, if China needs less stuff across the board, that means they're going to buy less stuff from Australia, and now the Australian economy is going to be impacted. Because now they're not selling iron ore, they're not selling coal, they're not selling gold, they're not selling Shiraz to the Chinese, so now they're negatively impacted. Okay, so that's the relationship connection that we as currency traders need. Sometimes there's a carry trade that presents itself where we can make money from the interest rate differential. True, that hasn't been a trade for many years. I used to do it a lot. But since the world has been at a zero interest rate policy, otherwise known as ZIRP, there hasn't been a carry trade. Now they are coming back because now we do have interest rate differentials, okay? So that's a trading style, but the basis of what we do as currency traders comes from analyzing the health of the economy. Not that we care, but are they going to trade? You have to have a good economy first that's productive. Are they making products and services? Look, you might have wonderful natural resources, but you still need a guy on a tractor to go out in the field and start digging. Okay? So that's the productivity we need. So now if that country has farmers that actually plow the fields, plant the seeds, and harvest, that's good. Now, then we can analyze, well, do they have good tools? Do they have good modern tractors? And are they using good modern fertilizers and pesticides or whatever that needs to go through that would increase their yield? That's a second side of, right, of how productive can this country be? Because if they have surplus, then you have opportunities for trade, and that's where we kick in. Because right, a wheat farmer in Australia, they need Aussie dollars in exchange for their wheat. But if somebody outside of Australia buys that wheat, they need to first go to the interbanking system, demand or exchange their local currency for Aussie dollars, and then exchange the Aussie dollars for wheat, then put it on a boat and bring it home. And that process is the process that we care about. So you got to know how Australia is doing and what they do, and then anticipate, right? But so that's, I mean, it's impacted by interest rates, but we're more interested in global trade. Okay? If you want to carry trade, by the way, do you got your eyeballs on the USD Mexican peso short? They raised interest rates again. 6% or 6.5? 6, I think. 6%. Okay, 6%. Okay, with 100 to 1 leverage, or let's say 50 to 1. You're in the United States, you have 50 to 1 leverage, and you're earning 300% internal rate of return just collecting interest. 300%. Plus pips. You want some of that? Let's see if I can change this chart. No, spinning. What? I forgot about this. I forgot about this challenge. Sorry, guys. We'll have to keep it fundy since I can't run MT4. And it's not MT4, by the way. It's not a Trader's Way issue. It's that for some reason on this machine, when I run the streaming software, it freezes up. It freezes up. And again, I'm looking at my CPU. It's 19%, so it's not my CPU. So I don't know what's going on, but I can't change my chart. So yeah, maybe. Yeah, but why? The issue is why. This is not an old machine. It's a i7 processor, so it's, like, we know it's not the processor, but why would it be the RAM? I don't remember on this machine. It's one of those things like, hey, it's $2,000. It should be good enough, right? Now I have an insane amount of RAM at home, but this is just my triple screen laptop. Stupid ThinkPad, huh? I wonder if there's somewhere in town I can go pop in some RAM. Do I have to put a mask on my laptop? Well, it's sad though too. Streaming software shouldn't be taking that much RAM. I mean, come on. Come on now. Come on. All right, so while that just farts around, euro dollar. Okay, again, we're stuck at the top. I don't think we'll end up having a long webinar if I'm running into this. But I want you to think about what I'm saying. Okay, I mean, hear me. Here I am. Rock you like a hurricane. I want you to hear me. I want you to really decide what you believe is likely to happen. Princey says, too many background operations. Yeah, but I'm not doing anything. I'm running the stream, right? The streaming software, OBS. I'm running MT4, which takes up almost zero resources. And I have one browser window open so I can read the chat. You're like, I think a $2,000 laptop should be able to do that. Oh my God. Okay, I want you to decide, are you a bull or a bear on the US dollar? I don't even care why. And I'm not going to beat you down and say, I'm right, and I picked bear, and you're bull, and you're wrong, and how dare you. I honestly don't care. And at the end of the year, it probably won't make much of a difference. It will make a difference this month. It'll make a difference next month. It'll make a difference in June and July and August. There will be months where you will have more opportunities than me. And in other months, I will have more opportunities than you. But at the end of the year, we will both do well. Okay? So that's the big thing here. Don't get caught up, right? Don't get caught up in trying to use technical analysis only to find trades. You will always find a trade, but you will probably always be inconsistent. Meaning you'll win today, lose tomorrow, win today, lose tomorrow. And more often than not, you get to the end of the year and you're not satisfied with your results. I want you to think about that. Why is that? And one of my arguments is it's the inconsistency. Every single trade is likely, not always of course, don't get all defensive on me, but on average, your trade entries, because you're not really a bull or a bear, are probably a little bit mediocre, a little bit late. You know, you're in the fourth wave, not the three. You're in the fifth wave, not the three wave. Right? It's just it's not accurate. Let's say you can't always be hardcore accurate when there's no strategy and all tactics, and it's tiresome too. So anyway, so if you know you're a bull only, you can stay away from bearish and otherwise mediocre trades and only trade in markets conditions that, let's say, are trending. So cool, you might go a couple of weeks without a trade, and then you might go 3 or 4 weeks with a lot of trades, but you're only trading in market conditions that you believe in technically and fundamentally. And it may not solve all your problems, but it'll be cleaner, it'll be more organized, it'll be, think about it, fundamentally and technically based, probably better than what you've been doing, let's say. Okay. Okay. You want consistency. All right. Let's see if I can open a chart. I just love charts, but yeah, I don't actually, price isn't even moving, right? So it's totally bombed out. Here I am, rock you like a hurricane. All right, let's take a look at what we got. All right, see, OBS high. Why? It doesn't do anything. So Google Chrome, all I have is the chat. Like, there's nothing else going on here. But now the CPU here says 96. Down there it says 15. That's interesting. So it's 16 gigs. It should be enough. That should be enough. I'm only using 4 of the 11. Yeah. Oh, man. It's weird, huh? Like I'm... Now it's the graphics card. But, dude, MT4 isn't heavy on the GPU. Like, dude, there's nothing going on. Like, no GPU is going to struggle with this. Oh, and here we are. But maybe it is. It's stuck at 80%, huh? Video processing, 3D. Is there a way to turn something off? Is it trying to do something 10 times more complicated than I need it to? Why is everything on 3D? Yeah, it ain't bad. Set your MT4 priority to high in the computer, make sure it runs best, but To me, I don't think it's MT4. I think it's OBS. Okay. I think it's OBS. Then Windows Driver Foundation. What the heck is that? That's sucking it up too. Yeah, it's the stream res, maybe. I don't know if I can change it while we're doing this. I don't think I can change while I'm streaming. But anyways. So it's unfortunate, but it gives us an opportunity for fundamental conversations, right? Oh, you think maybe it's the triple screens? Try to kill the camera? Yeah, I think I've done all that. I don't think it makes a difference. Yeah, I don't think even restart it. I'll do it just for fun. We're here. We're just amongst friends, right? La 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 la. So it was great hanging out with the boys last night. Cisco, Johnny and Joseph, cocktails. It was all good. Wonderful cigars. I can hear the fan. Yeah, I can kill one screen. Hang on, I got to get this booted up. I can kill a screen, see if that helps. Yeah, why not? So Lesso says, yeah, hey, the market's already priced in 50 basis points. Hey, by the way, the stream is now lagging. Like, oh, like it's a couple of minutes behind. The video is a couple of minutes behind. Interesting. Interesting. So let's see how this opens up. Okay, it's still lagging. All right, so let's do our tertiary change here. I'm going to shut down one of the screens. I'm going to move OBS over and out of the way, and I'm going to shut down screen 3. Just if you want to see the computer. showing. Mouse, mouse, blue mouse. All right, so that's my setup. Cool. All right, so I'm going to shut down one screen.